Karen Cho in London, thank you very much. Let's dive now further into the Fed's latest rate hike and the market reaction with Greg Hahn, President and Chief Investment Officer at Winthrop Capital Management. Also, Alfredo Romero, economist and CEO of Impact Analytics. Maybe, Alfredo, we'll start with you on that kind of bigger picture move here. We got kind of what was expected. The futures market had priced in an 84% chance we were going to get 75 basis points. There was an outside shot we would get a full 100 basis points or 1 full percent. Take us through why the markets, you think, reacted the way that they did if the economic narrative hadn't changed all that much from, say, Jackson Hole, Wyoming.
Well, you're exactly right. The Federal Reserve ended up doing what they told us ahead of time that they were going to do. They were going to increase the rate again by 75 basis points. I think the market reaction had nothing to do with that. It had to do with the change, with the change in the posture of the dot plot, and by telling us that they're not only going to continue increasing the federal funds rate a little more, they're going to continue doing so until they see clear signs that inflation is receding.
So that's a good point, Alfredo. That was probably what drove it, the dot plots. We are seeing now what Fed experts and central bankers expect to be a higher than we thought terminal rate for where things are going to end up in terms of rates this year, and perhaps that momentum takes over to next year. Greg, if you do have that kind of an interest rate tightening cycle in play and the markets are expecting it, what can we expect from markets now if we already know this is what's going to happen?
Yeah, Dom, higher interest rates are going to mean a shift in valuations, both for equities and fixed income, and we're seeing that right now. So we're seeing, 10-year yields on corporates at 5% and municipal bonds at 4.25%. I mean, investors can now invest and really earn income, which they haven't been able to really in about 15 years. So we're going to see a shift in valuations, and it's going to come through liquid assets and non-liquid assets. So we're kind of in this period with commercial real estate where cap rates haven't really adjusted higher like we've seen in the liquid markets, and it's been real quiet. So price discovery in some of the illiquid asset classes is going to be problematic. We're also going to see a shift in credit quality. So we would expect to see some deterioration in credit, and that'll probably come through the CLO, the leveraged loan market.
All right, so I'm very glad, Greg, that you brought that up, because this is a repricing, and this is what many traders and investors I've spoken to have talked about, that this is by no means panic. We've lost a lot of ground in the market, but it hasn't been like we've flushed out 1,000 or 2,000 points at a time in the Dow, or that we've risen that kind of amount on the other side. It's been this kind of revaluation. We're down 1%, 1.5%, up 0.5%, down another 1%. That kind of market action, does that scream repricing to you? That this is just a new regime where higher rates mean that stock prices and other assets have to go lower because risk-free rates are just so much better now?
Yes, and I think you hit on it, that this is a new monetary regime that we're working through. Monetary regimes last, on average, around 15 years. And what we're used to, investors are used to the Fed coming in and bailing out the market, and they've done it since the financial crisis in 2008. And we think, this is actually the Fed trying to earn its credibility back by really talking a book that's going to say, we're in this for the long haul, expect rates to continue to move higher. And they're willing to push this economy into a recession to do it. And the amazing thing that we're watching right now is that labor market is just so strong. We've got this labor market's, we haven't seen this strength in 50 years. And so to see what's about to happen with layoffs, we just saw Ford announce layoffs. We're going to see shifts in business models to support it. But that's really what companies have to do to support margins, to support profitability, to maintain valuations in a market that's shifting. It's just natural market movements.
So Alfredo, an interesting point being brought up there, that the jobs market, we're seeing anecdotal signs for sure, headlines, certainly in technology and certainly in some places in the industrial complex in America, where job cuts are coming or have already happened. It's only crazy because the jobs market is still relatively strong by many measures, and we've just seen through union contracts and everything else that wages keep rising. The knock is that they're not keeping up with inflation. So is this a scenario where we're going to go into a recession but still not have material weakness in the jobs market shaping around that?
Well, I think the chairman said it yesterday. This might be a scenario where we have a recession with growth. I think they finally abandoned this talk of the soft landing, and I think they're a little more clear in the fact that they had caused a little bit of pain in Wall Street, and the pain is about to come for Main Street. And if they can keep the unemployment rate between 4.5 and 5%, that would be just upwards of 2 million jobs lost. That might be just enough for the strength of the job market to keep the economy afloat and not cause a severe recession like before.
All right. So interesting moves here for sure by the central bank. Greg Hahn, Alfredo Romero, thank you both very much. We appreciate it.
Thank you.
Let's get a check on some of your other